Welcome to the Remote Real Estate Investor. My name is Mark Woodling. Michael Album and I are joined today by Max Feinberg, who's from Pittsburgh, Pennsylvania. So he's one of our certified agents and is going to give us a quick market breakdown and tips and tricks that we need to know about investing in Pittsburgh. So let's jump into it.
Thanks for having me.
No, really excited to have you on. So you are our certified agent out in Pittsburgh, right?
That's correct. Yep, Pittsburgh, Pennsylvania.
And are you a born and bred Pittsburghian? Is that the proper term?
Pittsburgher, yeah. I am. Yeah.
That's so much better.
We could go with Pittsburghian too. I was born and raised in Pittsburgh, Pennsylvania. I left when I was 18 years old, and I lived in Arizona for about 7 years, and I started my real estate career out there. But I'm back home in Pittsburgh, and I'm really enjoying working in real estate here.
Where in Arizona were you?
I went to Arizona State University, and so I was in Tempe, Scottsdale, Phoenix.
Okay.
Started my career in Scottsdale. Yeah.
A lot less snow out in Tempe, right?
Yeah. The weather was a little bit better, but it's not home. I'll tell you that much.
No, I totally can appreciate that. So, Max, curious to know, how did you go from Arizona real estate back to Pittsburgh real estate? Was it just, the homesickness, or you knew that market better, or you enjoy that market better?
It's a combination of a few things. Those are definitely part of it. Arizona is one of the more competitive real estate markets in the whole country. I'm not going to get the number exactly right, but I remember they had some crazy number of agents in the state of Arizona, over 40,000 or something like that. And so just inherently not being from there and not having that sphere of influence and network made it hard for someone who was just starting in the real estate industry to get, some traction. When you combine that with not really knowing the area, like you just mentioned, and being a little bit homesick, all those things brought me back to Pittsburgh.
Fantastic. And I'm curious, what's been the biggest change in Pittsburgh since you grew up there to now? What have you seen?
The biggest one has probably been, some of the factors that are making up the economic drivers here in Pittsburgh, the increase in tech jobs, healthcare, education, all of those things. And then what they've done to the real estate market, some of the crazy amount of appreciation we've seen in certain areas, and now it's starting to spill over into these other areas, and we're seeing a lot of development. When I was younger, we didn't have as much of that. Pittsburgh was still coming off that steel town reputation, and that's really changed a lot over the last 20, 25 years. Interesting.
So when people hear the word Pittsburgh now, what should they think of?
They should think of technology, healthcare, education. I know it doesn't, you still think of the Pittsburgh Steelers, you think of the steel mills and things like that. And I think there's only one steel mill left in the whole city. Those have been gone for a long, long time now. So, the main economic drivers, as I mentioned before, have totally changed. And we've become a really savvy city that's more cutting edge.
Interesting. That's really exciting to hear.
Yeah.
So as someone that's not familiar with Pittsburgh, asking for a friend, talk to me like I'm a brand newbie and give us kind of a high level walkthrough, if you will. If I'm looking at a Google map of Pittsburgh, how should I be thinking about some of the different sections, submarkets, areas, if I'm an investor?
Yeah, it's funny you say that, because I always tell clients I'm working with, looking at a map of Pittsburgh is really not helpful at all. Because for a few reasons. One, we have over 90 different cities that comprise of a fairly small, big city, a small major market. So we have a lot of small little neighborhoods, which are all really different. And outside of the city of Pittsburgh, there's another 150 or so small neighborhoods. So when you combine that with really the topography of the area, looking at a 2D map as an investor really doesn't help you too much.
Great to know.
A town that could be right next to another town on a map would be an A+ type community with great schools. And you look at a map and you say, well, these prices are lower right next door. Why can't we invest in this area? Well, it's across a river and there's a mountain there. And, it looks like it's next to it on a 2D map. It's really not the case. So it's definitely helpful to be familiar with the area. And that's where I could come in, or I had a lot of clients come, fly into Pittsburgh and drive around and really learn a lot from just doing that.
What you just said, I think, is so valuable for so many investors, because I think so often, especially remote investors, will take our local knowledge and apply it elsewhere. And to your point, you just can't do that. You can't do that ever, and especially not in Pittsburgh. So this is great to know. Okay, so then talk to us about some of the markets, submarkets, neighborhoods that you are seeing really ripe for investors where folks are doing quite well?
Yeah, there's a few different types of investments that could work here in Pittsburgh, as I'm sure there are in other areas. And with there being so many different communities, I would say there's really not one answer to that, right? There's communities such as Lawrenceville or Shadyside or East Liberty, where we've seen a lot of these companies like Google or Facebook or Uber move from Silicon Valley and open offices here. And so those are more appreciation plays, right? Or maybe Airbnb or a property like that works in these areas. But when we're looking at analyzing them for cap rate or cash on cash, the prices are a little too high. So where we see a lot of success with investors in Pittsburgh is some of these areas that are a little more obscure, a little lesser known, that I would call more B to C plus type areas. And we have a lot of them. There's no shortage of them. Like I said, there's 100 of them.
Okay.
So
awesome. And kind of digging into the numbers a little bit on those more appreciation plays, can you give us an idea, just a ballpark idea of what a 3-2 would cost and what it would rent for versus some of those more cash flow heavy markets?
Yeah. I mean, in Lawrenceville and areas like that, some areas that are popular with nightlife would be like the South Side, Mount Washington, Lawrenceville. These types of places, a 3-2 is probably going to be the lower end would be 250. You're probably going to be in the 350 to 400 range for something that doesn't really need any work. Mm-hmm. And the rents are going to be, in the mid 2000s. So on the surface, if we do, napkin math, right? Back in the napkin math, that doesn't really meet that 1% rule that we look at to further analyze a property. But, right. You are getting appreciation. You are in areas where, it's probably a better tenant base that, wants to be in those areas for the nightlife and things like that. So,
yeah. A totally random question. Where do you think the term back of the napkin came from? Is it because is there like food stain on the front, so you got to turn it over?
I like to picture a couple guys sitting in like a pub in England or something, maybe just doing some math on the back of a napkin. Right. I'm not sure.
Yeah, no one ever says some front of the napkin math. It's always back of the napkin.
So Max, I got a quick question. What's the sweet spot that you're finding right now between, the cash flow markets and the appreciation markets? Where do you feel like the opportunity is that most investors are really gearing towards, and it's competitive, but not overly competitive?
Yeah. So for Pittsburgh, there's a few different answers to that. If you're looking for single family homes, in those B to C plus type areas, we're going to be looking at prices that are in the low to mid 100s, just because that's where the rents are going to match up and we're going to be near that 1% rule or maybe a little over it. Now, like most cities, if you get a little further away from town or you go to some areas that are a little less desirable, we may be able to find single family homes where the numbers look a lot better and there's inherent risk involved with that as well. The buildings are a little rougher. You may have more tenant turnover and issues in that regard. But that's generally where we're going to be for a 3-bedroom, 1 or 2 bath home. Duplexes and triplexes are going to be probably in the mid 100s to low 200s at this point, which has really gone up, I'm sure like a lot of other cities in the past 2 years, from, the low to mid 100s to high 100s. Each thing's probably gone up about 30,000. So, probably about 10 to 15% appreciation. But that's where we're going to see the numbers. I like to steer clients towards duplexes and triplexes if they're looking for cash flow. We know that there's probably more turnover on multi-units than there are single-family units, but cash flow is generally going to be a little bit better around here.
Max, you bring up such a great point, and it's something that I talk to members in the academy all the time about. How do you have the conversation around someone who says, well, Max, here's this $120,000 house that rents for $1,200, let's say, but over here, here's this $180,000 duplex that rents for $2,000 gross. And you have to explain to them that those tenants might be very different. We have to get beyond the gross numbers. I mean, how do you have that conversation?
Right. Yeah, well, that's tenant turnover is just part of it. I mean, here in Pittsburgh, as I'm sure we'll touch on in a little bit here, some of these buildings are older and utilities are separated in some instances. They're not separated in some instances. The owner may be responsible for paying water and electric. The tenant pays gas. Whereas in a single family home, generally the tenant's responsible for paying all the utilities. When you dive into the numbers a little bit more, may actually make those single family homes more attractive than they first appeared. But yeah, no, tenant turnover is part of it. Utilities being split is part of it. Just property maintenance is part of it. I mean, you've got 2 kitchens, 2 bathrooms, if not more, probably bigger buildings. So there's a lot of factors. While the cash flow may be a little bit better, your expenses may be a little bit more as well.
That's such a good point to keep in mind.
Yeah.
So you mentioned it, and I would love to come back to it. So the age of the housing stock in Pittsburgh. Talk to us about what that looks like. Is it new builds? Is it 200 years old, 100-year-old? What is the age of some of these properties that are good cash flow investments look like?
Yeah, we don't really have a whole lot that's over 130 years old. And most of the stuff that's going to be that age is going to be really close to the city center. So some of the neighborhoods like the north side, south side, you look at the date those were built, and those were in the late 1800s. But oftentimes that scares people without even really looking into it. I mean, these places were built to last, a little bit different than they are nowadays. And then we have new builds that are a little
weren't built with sticks.
Yeah, right. Yeah, it's a totally different thing. I was just at a friend's house yesterday who has a townhome that was built less than a year ago. He's already got plumbing issues. So, sometimes age isn't a bad thing, but there are issues that are associated with having buildings that are 100 years old or so, which is where I would say a lot of these properties are going to sit, about 100 years old, 80 to 100.
And how do you discern or decipher? I mean, so I would give you an example. I have a fourplex that was built in like 1890, but I took it down to the studs, brand new everything, brand new, roof, electrical, plumbing, whatever. And so on the insurance, it says year of construction 2019. So how do you coach people? How do you walk people through? Yeah, I know it says it was built in 1900, but it's been rehabbed. So for you as the owner, its effective year of construction is 2020 or whatever.
I tell people that all the time. I say, if this building was built in 1880, there's very few things in this building that are still from 1880. One of them may be the foundation, which I know is a big issue for a lot of people. But again, these foundations oftentimes are 18 to 24 inches thick, and they're not going anywhere. But as you touched on, the plumbing, electrical, roof, all this stuff's probably within 50 years old. So, we go in there, we do inspections, and we figure out the age of some of these mechanicals, and we're better able to figure out what we should be estimating for maintenance, CapEx, and things like that.
I love it. And so you touched on foundations, and there may be some damage to those foundations. What are some other common issues that you see in the Pittsburgh market that maybe are custom to the Pittsburgh market that might scare other investors away? Like for one, we were chatting with an agent, they have termites. Everywhere they have termites. So if you see termites, it's not a big deal. What's kind of unique to Pittsburgh?
Termites is one of them. It's not crazy common around here. Termites are prevalent though, but a lot of the issues that we see here that I've noticed have caused pause for some investors from out of state are related to the foundations and then kind of our pretty awful weather. So, these foundations that are from 1880, 1890, they didn't use basements back then the same way we do. And they designed these houses with foundations that are oftentimes fairly porous. And then when you combine that with the amount of rain that we get here, we see issues like mold. We see issues like dampness in basements. And then, some settling and foundation shifting that's associated with age and moisture. These issues are pretty common around here and definitely can be cause for large concern, but oftentimes are not. And, I talked to Mark about this a few weeks ago. I work with one guy who says mold is gold because it scares people away, but it's really easy and common. It's an easy thing to fix. And it's so common, but when you deal with people from Arizona, for example, they hear the word mold and they just shut down. Right. So those would be a couple things. A couple other common issues around here have to do with the age of buildings and cause people to hesitate or odd layouts. We have sometimes these duplexes or triplexes that were single family homes maybe 100 years ago, and they've been repurposed over the last 100 years, and they've got really bizarre layouts, and they're not your traditional up, down, or side-by-side duplex. We've got very small bedrooms that really should be closets, attics that are finished, basement bedrooms, things like that if you trace the lineage of a property back, you'll find that every 20 or 30 years or so, something was done and changed it a little bit. So those are a few of the things. And then just other issues that are associated with older buildings, which we kind of already touched on.
Yeah, that makes total sense.
Yeah, Max, I think one of the important points to the mold aspect is it's so cold up there that, mold really thrives on heat, right? And that's where a lot of the water just kind of, it turns into mold once the heat gets to it. But out there, the freeze, really takes care of it. So you're not going through these vicious mold cycles out there. It's really just maybe more seasonal, if anything, right?
Yeah, I would say it's not as common in the winter, but these basements, again, they a lot of them just let a lot of water in. And if you're not running a dehumidifier, or, there's a lot of people that do external French drains and things like that, there's ways to combat these once you remediate the actual mold issue.
That's great to hear. Mold is gold. Well, we'll save that only for the more expert investors out there that really can coin that phrase. But I think that's good for anybody, so it doesn't freak them out, once they see some of those items.
Right.
So, Max, I come from a long background in the insurance industry. So I'm curious to know, in Pittsburgh, do you guys have natural disasters? Do you have tornadoes, floods, hurricanes, that kind of thing?
It's funny you say that. It's another thing I like to talk to out-of-state clients about. While our weather here is not notoriously great, we get a lot of rain and it's fairly overcast, we actually don't have many natural disasters. We really don't have earthquakes. We have tornadoes, one tornado maybe every 3 to 5 years, and it touches down and it's gone. And, I guess we do have some floods because of the topography and the amount of rain. And there, you coming from insurance, I'm sure you're familiar with, we do have a lot of properties that require flood insurance. Mm-hmm. So that's something that we dive into, before we commit to a property, because that can be a little pricey and can hurt the numbers if that's another $1,200 a year or something. Right. But, the weather here, it doesn't get too hot. It's really not as cold as some places, in New York or Minnesota or Wisconsin or places like that. It's not as hot as, some places in the South. So it's fairly mild here, in my opinion.
You're talking to a guy from California. So the fact that snow is part of the equation, the mild is no part of that sentence.
Right. Yeah. Well, yeah, with no earthquakes here. So we'll take that.
Yeah, I was going to say that's a big win. That's a big win. Sign me up.
Right.
Okay.
Right.
And so, Max, I'm curious to know, or for investors to know, because I think property taxes is one of the biggest misses that investors encounter in investing remotely. They often know what their property taxes look like in their county or their state, but going across the country or across state lines can often change things. So do you know how people should be calculating their property taxes?
Totally. That's the biggest one I've seen. Mark and I have talked about this as well. A lot of times we've got buildings here that have been owned in the same family for 70, 80 years. And on the surface, you look at the taxes, it's like, wow, $200,000 and it's only $950 a year in taxes. Well, that's what it is now, but it's going to change. So that's one of the conversations I like to have with people. And it varies county by county here. So Pittsburgh's in Allegheny County. And that's where most of the properties that we're going to be talking about or Roofstock's going to be publishing are going to be located in Allegheny County. Generally in Allegheny County, the way they reassess these properties is approximately 80% of the new sales price. And then the millage rate in each township, which we just discussed, there's a ton of them, varies. So I can't really give a one-size-fits-all answer there other than you can calculate the assessed value based off your purchase price and then go check out what the millage rate is for whatever neighborhood that property is actually in and go from there. Once you get outside of Allegheny County in the neighboring counties such as Westmoreland, Butler, Beaver County, places like that, they're all calculated differently. So we could go on a one-by-one basis there, but Allegheny County, for the most part, that's how it's done.
Okay. Perfect. And that's what I always share with folks too is, hey, just go call the county assessor, ask how you calculate your after sale property taxes. So this is super helpful. So for anybody listening who's interested in investing in that market, go look up the millage rate for that specific area and multiply it by 80% of the purchase price.
Approximately. It varies year over year. Sometimes it's 75, but that's a safe way of calculating it.
More or less. Okay, cool. Mark, do you have some other questions for Max?
Yeah, I think it's good to know really what your expectations are because it's a two-way street. Buyers are putting in offers on Roofstock for MLS properties. We would kick those offers over to you as a referral, and you're going to work with those buyers. But when you have that first conversation with buyers, what is it that you always emphasize or some of the common things that you say, hey, before we move forward and submit this offer, let's make sure we have these things in a row. What is it that you go through?
Well, I'll tell you this, Roofstock's done a really good job of making sure buyers are pre-qualified and ready to buy. So it's a little different for buyers I work with from Roofstock than maybe someone I've met through another means. But the biggest thing with expectations is I try to let people know that the market's still pretty hot. It has slowed down a little bit, especially in the multifamily world. But if we see a property that the numbers look really, really good, a lot of other people are seeing that property and they're running those same numbers as well. So you just got to be ready to go. And I know a lot of people, a lot of times being from out of state, have a lot of questions, and some of which we've just covered. How do I calculate taxes? What are some of these issues? So I like to just try to have this conversation with them initially and say, hey, here's the answer to these questions. By the way, we also have a 10 to 14 day inspection period where we can make sure we're not getting into something that we shouldn't be getting into. So if a property looks really good, I just want people to understand that it's going to be gone still within 24 to 48 hours around here.
That makes total sense.
That's great. And when you submit an offer and you hear back from, let's say, a listing agent, what's the typical back and forth that you have with a buyer? Because I know some agents give you extra information and give you some ideas about, where you need to be. How do you approach that with a buyer to give them as much market intel just so they can really either submit that offer or say, hey, you know what, this may not be, the best offer on the table. So let's go shop for another property.
A lot of times, especially with deals that are really competitive, I just tell people, even if it's not a highest and best situation, sometimes it's best to put your best foot forward and just say, hey, this is what I'm willing to do. This is my personal highest and best situation. And if someone else wants to do 10,000 more or is able to offer cash, then so be it, right? And this one wasn't the one that was meant to be. But that way, at least, you're not trying to squeeze out $2,000 or $3,000. I try to help people understand that if you're going to look at this as a long-term investment, $2,000 or $3,000 off a sales price when you're doing a 30-year mortgage is so small that if you think this is a property that you really want and looks like a good deal, let's go for it, right? And we can do our due diligence on the property and some of these other things during an inspection period when we can still get out of it and you can get your deposit back.
And Max, to your point, I mean, even putting your best foot forward, knowing that you might still lose out on the deal allows you to potentially become that backup offer if the first deal falls through. This just happened to me.
Totally.
The selling agent came back and said, oh, our other buyer fell out. Are you still interested? And I said, yeah, we can talk.
Yeah.
Let's have that conversation.
Yeah, we could talk. Now that offer might go down a little bit, right? But,
exactly. You got to pay for them rejecting me.
That's right. That's right. Yeah. But, that's happened a lot around here. And I'm glad you said that because I think we've had a lot of appraisal issues lately. I'm not sure if this is happening in other markets, but I think appraisers, especially around here, are tasked with the difficult job of trying to cool off a hot market, right? They see these prices going up, and they don't want to be the ones left holding the ball like 13 years ago or 12 years ago. And so we've had a lot of, appraisals come back low lately. And that's really opened things up for what you just mentioned. Hey, this person doesn't want to buy it anymore. Hey, is your offer still stand? So I'm glad you said that because we've seen a lot of that here.
Interesting. And so in terms of the offer prices that you're seeing properties go under contract for, are they, and keep in mind, everyone listening, we're recording this end of September 2021, but are they at list price? Are they over list price? Are they under list price? Where are you seeing the winning offers coming in?
With single family homes, we're still seeing them above list price pretty often. With multifamilies, not quite as often. I feel like there's a few reasons for that. Obviously the first and foremost being there's less people looking to buy multifamily properties as there are single family properties. But multifamilies are still going to be around list price. I just had a client lose out the other day. We went $7,000 over on a $125,000 duplex, and I think the winning bid was probably about $10,000 or $11,000 over. So that's still common. We don't really have anything, more than 10 or 20,000 over for the most part, just because you don't really go 50,000 over, on a $200,000 purchase. I'm sure in places like California, you may see it more often because the initial price is higher, right? But here, the percentage is, never really too much more than 10% above list price.
Okay. And are you seeing people get really aggressive and creative with the terms that they're offering?
Yeah. I mean, a lot of people still waiving inspections, and I know that's something that's hard for a lot of Roofstock clients. And I don't really honestly expect a lot of Roofstock clients to want to waive inspections as they've never seen the properties. But sometimes you have to remember you're competing against local investors as well who have experience and they've walked that property and they're comfortable waiving inspections because they already know, what's needed or what's not. So that's obviously still a big part of it. And we're seeing, lease backs to the owners because it's hard to find properties for them to move into. So they're letting owners stay, for 3 months for free. There's a lot of creative things going on right now.
Interesting.
Still people covering appraisal differences as well. Even if you're doing a purchase with a loan, you can still waive the appraisal contingency, but you're going to be responsible for covering that gap. I've seen that more often in the last few months than I have in the past as well.
And so, Max, when you're getting an offer submitted through Roofstock, how many times are you doing a lease back? Like what percentage are you waiving, the inspection contingencies or any of those? Like what's the common ratios that you're seeing out there?
For Roofstock, not as much. Again, the Roofstock clients are usually out of state, and so they feel more comfortable at least having an inspection done. And so I try to help them understand other ways that we can improve the offer. Obviously more money is helpful, but maybe more deposit money, maybe a quicker closing, whatever it may be. There's other ways to make your offer more attractive. Maybe you just tell them, hey, I want to do an inspection, but it's going to be an as-is sale. I'm either going to take it or leave it. I'm not going to use this inspection to really beat you guys up and negotiate any further. I just had a Roofstock client do that this week. So leasebacks not as often, but other creative strategies are pretty common.
Awesome. And Max, when you're putting up properties onto the Roofstock Select program in the Pittsburgh market, what criteria are you looking for? What is it that when you see a property screams, oh, perfect investment property candidate?
Yeah, Mark and I have talked about this a lot, and I'm still trying to find what's best for the Roofstock investors. And I think the answer to that is there's investors that are looking for all different types of things. So I'm trying to get creative and put all different types of properties on there. I've been doing a lot of properties in these Lawrenceville types areas where the initial return doesn't look great, but I found that there's Roofstock investors who are from California or Washington, and they're still looking at it saying, man, these are still really good numbers. So I'm doing some of that. A lot of the B to C plus properties where we're looking at a 1% rule. That's one of the things I'm looking for. And then I've been uploading some properties to Roofstock lately that are in some of the areas where the returns are going to be a little higher. And on the front end, I've really found it's important with those properties to have these conversations about potential issues. So there's all sorts of different criteria for what we can find in Pittsburgh.
Oh, that's great. And cool to hear that Pittsburgh does really cater to every investor type or every investor persona with the type of asset that you have in the market.
Absolutely.
Yeah, I have a few stats I want to throw at Max and just see if he has any comments around these, because I was just studying John Burns real estate data, which is a great source of information. It shows that rents were up 2.7% from 2020, basically. So over the last year, it was 2.3% in 2020. In 2019, it was 3.6%. So slow and steady, I would say, is always good. The existing home prices jumped. This is a median number from 173,000 to 192 in 2021. So over the last year, it's jumped up a nice percent. Was that clip about 20% clip? It's not too bad, or 10% clip, excuse me. Here's the number that stood out, and I would love to hear what Max has to say on this. So I'm looking at the cost of a payment and maintenance to own versus the cost to rent. And it shows that the cost of a payment with maintenance for let's call it an entry-level home is $997 a month versus that same entry-level home to rent is about $1,416. Max, are those numbers accurate, or what do you see in the market?
Yeah, that sounds accurate to me. Like I said, $1,400 a month in rent would be about probably a $170,000 home, depending on the area. But so that average rent sounds just like the average purchase price you just mentioned. So that sounds spot on to me. And I'm glad you brought that up, the rent increase too. One of the other things that we see around here a lot, which I've had conversations with a lot of Roofstock investors about, is the current rents of these properties we're uploading. We have a lot of properties here that are older, have maybe been passed down through families, tired landlords, and the rents are just crazy low. And so, when we initially upload properties, if there's tenants in there, the numbers may not look great on where they are now. And there's a lot of reasons for that. And the most common reason is landlords just really not raising rents and keeping up with how fast they've appreciated, like you just mentioned, Mark. I think a lot of these older, tired landlords don't really go and check the real estate stats like that and say, holy cow, I should have raised this, 10% over the last 3 years, because that's what it's gone up, And people don't realize that, they're still sitting at $650 a month for a 1-bedroom, and, it should be at $850 now. And that changes everything. That's really, really common around here.
Yeah. That's such a good point, Max. And I was just having a conversation with some investors yesterday talking about the difference between buying on pro forma or buying at true value. And so what we're talking about is, because it's single family, it's a little bit different than multifamily. But for single families, if the potential is truly there, I think it can totally make sense. But you just want to avoid is a seller saying, oh, well, the market rent's $850. My current rent's at $650, but you have to pay the price to buy the home at the $850 rent when really the market is $700, right? That's where you get yourself into big trouble.
Right. It's like, well, you should have gone and done it then, right?
Yeah, why don't you do it and then I'll pay for it?
Right. Why don't you do it then and keep the house? But, what I'm seeing a lot of times is that in this market, we're kind of purchasing in the middle of the pro forma and true value. People are pricing them at the true value, and the pro forma is, 20,000 below that or 30,000 below that. And oftentimes where we're settling is somewhere in the middle. So yeah, I'm glad you said that.
Okay. Well, that's super good to know as well. And what tools would you recommend investors utilize to get a handle on what are the true market rents?
Wow. This is a conversation I have all the time. I wish there was some sort of rental appraisal software where there was an actual correct answer for that. But really, we have this conversation a lot. There is no such thing as a rent appraisal, right? It is whatever someone's willing to pay. The tools I use are probably the ones that a lot of other people use. I use Zillow Rentals a lot. I use Rentometer a lot. I use Craigslist. I look what's out there. I just try to look at everything that's, really available. And then oftentimes, if it's still available, I'll take 10 or 15% off of what that is and say that's probably about where we should be. Otherwise, again, it would be rented at that price, right?
Right.
So
it wouldn't be available.
Yeah, it wouldn't be available still if it was priced correctly. But we use Rentometer. I use Rentometer a lot. Zillow Rentals a lot.
Yeah, those are both great tools.
So I have two more quick stats. One of them's vacancy. So we're showing the vacancy rate is actually like 5% going all the way back to 2016. So 95% occupancy, as you guys would say. Do you find that that's true? Or, it sounds like it's a very competitive rental market out there. Is that right?
It is a competitive rental market. I always go back to two things when I think about how competitive the rental market is and how people don't really realize how competitive it is. I purchased a building in December of last year, so it's been about 9-10 months. And the owner was living in the downstairs unit, which was a really nice unit. And they told me, it's probably worth $750, $850 a month. Well, I went on Facebook Marketplace, listed it for $1,100 a month. I got all of these comments. You're crazy. Second day, rented. So it is competitive. People don't realize what true rents really should be and how many people are actually looking for a nice property. If you've got a nice, clean property, people are willing to pay because there's not a lot of those available.
That's awesome.
Wow. Well, the backup statistic to that is 53% of the housing units are tenant occupied. So renters are occupying 53% of the property. So that shows you home ownership rate out there is just not as strong. And that's in the city as Pittsburgh. So that's where the competitive nature is coming from versus ownership rate is 64% nationally.
Right.
So you flip those numbers around and you see that there's that many more renters in Pittsburgh.
Yeah. And it's really, I've heard that stat and it's really amazing to think about when you think about the cost of purchasing a property here. It's amazing that it's not flipped around and you can buy a nice house for $170,000 10 minutes away from the city, but rental rates are really high here. And I'm not really sure why. I think maybe it's because we have a lot of out-of-state investors and, I'm not really sure beyond that, but the opportunity is there. There is a large rental pool and not a lot of vacant properties, as you just mentioned.
Interesting.
That's great. Well, to me, that's what sums it up right there is that there's the slow, steady rental growth. There's a tenant occupancy. There's a demand for tenants that are coming from both your side as well as they're looking for properties. So it sounds like the supply and demand is very healthy on the renter side, which is going to really drive investors to the market. Yeah,
and rising rents and rising ARVs as well. So it's a good time to get in.
Max, this was great. This is the comments on just, what the common things are that you're seeing out there. I mean, this is the information that you probably have the conversations every day, maybe 5-10 times a day. So glad we could get that out there and share it with the listeners. So, Michael, this was, he was probably one of the better interviews, I would have to say, because it's demystifying, right? All the little things that people hear about, but you really need to hear it from the locals.
And I can say wholeheartedly, Max, that we don't say that to everyone.
I'm going to have to go back and watch the other interviews now to make sure. I'll send you a text. Don't do that. Thanks, guys. I appreciate it.
No, Max, this was great. Thank you so much.
That's awesome. All right. Thanks again, Max, for joining us. And thanks to all the investors for listening. And we'll catch you on the next one. Happy investing.